When you're at that level, it has all just become a game of confidence. That quote perfectly captures the actual reality of global finance. Because at the absolute highest tiers of the banking world, once you strip away all the complex algorithms and the fancy marble columns, everything fundamentally boils down to a super fragile game of trust. Seriously, if people believe in the institution, it stands. But if that confidence wavers even a little bit, the entire empire can literally crumble in a matter of hours.
Welcome to This Explainer. Today, we're going to completely unpack an epic, century-long corporate drama. We're looking at how a tiny, localized storefront, one meant just to serve working-class immigrants, evolved, struggled, and eventually exploded into a global financial leviathan. We're talking, of course, about Bank of America. Now, this isn't just some boring story about money. It is a fascinating case study in pure ambition, cutthroat corporate warfare, and the constantly shifting definition of what a bank is actually supposed to be.
So, to make sense of this massive journey, we're going to break things down into 5 historical eras. First, an empire built on trust. Second, war with Wall Street. Third, boom and the bureaucracy. Fourth, predators and poison pills. And finally, number 5, too big to fail?
All right, let's jump right into Chapter 1, an empire built on trust.
The story of Bank of America is actually the story of a guy named Amedeo Giannini. Giannini was the son of hardworking Italian farmers, and he was honestly just outraged that the established banks in San Francisco were completely ignoring the local Italian immigrant community. So, what does he do? He starts his own bank. Originally, he calls it the Bank of Italy, and it was built specifically for the working class. But his real test, the moment that permanently defined the bank's DNA, hit on April 18, 1906. That's when the devastating San Francisco earthquake struck, bringing massive, uncontrolled fires with it. And Giannini? He didn't freeze. Before the fire could even reach his vault, he and his stepfather physically loaded all the bank's cash, gold, and silver onto wagons, cleverly hiding the whole stash under crates of fruits and vegetables. They made this grueling, all-night journey just to secure the funds. And get this, just days later, while the city was literally still smoking, he set up a makeshift desk on Washington Street and got right back to business.
Now, while all the other banks panicked, completely froze up, and flat out refused to lend anyone money, Giannini made an extraordinary move. He started offering unsecured loans to the earthquake victims based on absolutely nothing but a handshake and their personal character. I mean, wow, right? He basically turned a catastrophe into the ultimate marketing campaign for trust. It cemented his bank's reputation for total reliability, and almost immediately, people started pouring their life savings right into his vault.
Of course, that kind of success breeds immense ambition, which brings us to Chapter 2, War with Wall Street.
So, by the 1920s, Giannini realized that branch banking was the future, and he wanted to expand from coast to coast. But to build a true empire, he had to break into the most prestigious financial city in the entire world, New York. When Giannini moved in by scooping up local banks, it was seen as a direct act of war by the undisputed king of Wall Street at the time, J.P. Morgan Jr. This set up an absolutely intense clash of characters. In one corner, you have Giannini, this West Coast upstart with Italian immigrant roots, championing the common worker, and in the other corner, Jack Morgan, East Coast elite, deeply old money, incredibly intimidating, and a guy who famously despised any kind of competition.
Well, during the brutal stock market crash of 1929, Giannini's banking holding company Transamerica took a massive hit. Sensing weakness, Morgan and his wealthy allies actually orchestrated a secret boardroom coup, completely forcing Giannini to resign from the very company he founded. Can you imagine? But Giannini was definitely not going to go quietly. He decided to launch his revenge using a corporate mechanism called a proxy fight. Basically, that's exactly what it sounds like. You rally up enough shareholder votes to just completely overthrow the current corporate management.
Let's walk through this epic comeback, because it's pretty wild. Giannini immediately formed a group called the Associated Transamerica Stockholders. He hit the pavement and actively rallied his working-class shareholders directly. He leaned 100% into his hard-earned reputation for honesty, contrasting it with the absolute ruthlessness of Wall Street. And guess what? It worked. He won the vote, fired every single Morgan loyalist on the board, and traveled back to the West Coast to crowds of thousands of cheering employees. The press at the time actually compared him to Julius Caesar returning victorious to Rome.
But here's the crucial point. If you really want to understand Giannini's motivations, consider this number, $489,278. When Amedeo Giannini died in 1949, despite having built the absolute largest private bank in the world with over $6 billion in assets,
This modest sum was the total value of his personal estate. He famously believed that a banker shouldn't actually have too much money. He was truly, genuinely, in it to build a bank for the people.
But, as we all know, after a visionary founder passes away, a company's DNA almost always starts to shift. And that brings us to Section 3, Boom and the Bureaucracy.
As America entered this period of unprecedented post-war prosperity, the 1950s and 60s turned into a golden era for the bank. Under the leadership of CEO S. Clark Bies, Bank of America surfed this massive California economic wave. In 1959, they did something truly revolutionary. They launched the Bank AmeriCard. This gave ordinary customers super easy access to consumer credit, fundamentally altering how Americans spend money to this day. They also smartly seeded massive investments into emerging local industries, essentially bankrolling the early, scrappy days of Silicon Valley tech, not to mention the boutique wineries of Napa Valley.
But, massive growth usually comes with a dark side, complacency. By the 1970s, under CEO Tom Clausen, Bank of America had morphed into a bloated, sluggish bureaucracy. They completely missed the next major technological shift. Just compare them to their rival, Citibank at the time. While Bank of America was dragging its feet, Citibank's agile risk-taking leader, Walter Wriston, took a massive $50 million gamble on brand-new automated teller machine or ATM technology. Because Bank of America was just too slow to react, Citibank swooped in and temporarily stole the crown as the top commercial bank in the country.
And sadly, that misstep was just the tip of the iceberg. Let's move to Section 4, Predators and Poison Pills. As we speed into the chaotic 1980s, this once impregnable bank suddenly finds itself literally fighting for its survival. Under the leadership of Sam Armacost, the bank entered an absolute death spiral. They got hit by an overwhelming list of simultaneous crises. A humiliating $95 million loss from a fraudulent mortgage-backed security scam, crippling exposure to the third world debt crisis, the disastrous fallout from the Penn Square Bank failure. The bank's stock price was absolutely plummeting, and internal morale was completely shattered. And, as you might guess, a dying giant in the corporate world inevitably attracts predators. This next part brilliantly illustrates just how vicious corporate defense can be. A ruthless corporate raider named Sandy Whale saw the bank's weakness and attempted a hostile takeover, openly vowing to remake the bank in his own image. In a sheer panic, the board actually fired Armacost and brought back their former CEO, A.W. Clausen. Clausen immediately executed a classic corporate defense tactic known as a poison pill. Basically, he rapidly issued massive amounts of new shares to existing shareholders. This instantly diluted the bank's ownership value, making the takeover astronomically expensive and entirely unappealing for Whale. The bank managed to save its independence, but man, it was a close call.
So having successfully fended off the raiders, Clausen went right to work. He aggressively shed assets to trim the fat from the company. Combined with the booming Reaganomics of the late 1980s, Bank of America pulled off a truly miraculous turnaround. To put that into perspective, their stock rocketed from a dismal $6 a share in 1985 all the way up to $19 by 1988. That actually made it the best-performing bank stock in the entire world that year.
Which brings us to our final and perhaps most sobering chapter today. Section 5. Too big to fail.
Moving into the 1990s and the 2000s, banking executives developed a deeply, deeply dangerous obsession with size. Under CEO Hugh McCall Jr., the new mantra became safety in big numbers. But that relentless quest for scale set the stage for the catastrophic 2008 financial meltdown. The bank's unscrupulous expansion had dangerously blurred the lines between safe, everyday commercial banking and highly risky investment banking. Then, a disastrous acquisition of Countrywide Financial loaded their books with absolutely toxic mortgages. When the market finally crashed, they were forced to absorb Merrill Lynch just to prevent a total systemic collapse of the U.S. economy. In the end, this once fiercely independent institution required a staggering $45 billion government bailout just to survive.
And this all builds right back to the very first point we made today. Consider the number $5 billion. Even after the massive bailout, the bank was bleeding trust. The new CEO, Brian Moynihan, realized that to stabilize the ship, he needed the ultimate symbol of financial confidence. So in 2011, he secured a massive $5 billion investment from Warren Buffett. But here's the thing, it wasn't really about the cash. It was about Buffett signaling to the global market that Bank of America was safe again. Remember, at this level, it is all just a game of confidence.
So where are we today in 2024? The bank has undoubtedly recovered financially, for sure. They boast incredible metrics like a highly successful digital transformation, strong earnings, and great dividends for investors. But you really have to contrast that with the grim customer reality.
We're talking endless consumer complaints, massive fines for regulatory noncompliance, and opening unauthorized accounts, excessive fees, and just terrible customer service. The bloated bureaucracy that took root decades ago has created a massive, glaring disconnect between the boardroom and the everyday consumer.
Which leaves us with this final, vital question to think about. If banking is fundamentally just a game of confidence, can a modern, bureaucratic behemoth truly survive long-term if it has entirely forgotten how to build trust with its everyday customers? Think back to Amedeo Giannini, out there lending money on a handshake out of a fruit wagon. Would he even recognize the massive, penalty-ridden global institution that his localized, trust-based immigrant bank has become today? Well, I'll let you be the judge of that. Thanks for joining me for this explainer, and I highly encourage you to keep questioning the massive institutions that shape our world.